Hello and welcome to another accounting tutorial where in this session we'll be taking a deep dive into the Payables Ledger Control Account. Now this account has really been on a name journey over the years, and you may see it referred to in other videos or articles as creditors, purchase ledger control account and trade payables, or as we now know it, the Payables Ledger Control Account. By the end of this video, you should be able to answer the following questions. What is the Payables Ledger Control Account? What is it used for? And how do we prepare the account? Let's start from the top then. What is the Payables Ledger Control Account? Well, this account shows how much money a business owes its credit customers. So for most businesses who sell to other businesses rather than the general public, they will sell goods on credit rather than an immediate payment. Your Payables Ledger Control Account is there to show the total amount the business owes to its suppliers. It's classified as a current liability, which means that we should expect for the money to be paid within the next 12 months. Next then, what is it used for? The balance on this account will be used to prepare the business's financial statements, both on a monthly basis and at the end of the year. It will also show managers at a glance how much is owed in the short term to its suppliers. The balance on the account will change on a regular basis. Every time an invoice is paid, this will decrease the balance on the account, as the business would no longer owe that money. Another use for this account is as a control mechanism for the business. The Payables Ledger Control Account should reflect the total amount owed on each individual supplier account were the business to add them all together. If all the supplier account balances add together don't equal the balance on the Payables Ledger Control Account, then there must be an error somewhere in the records. Now the all-important, how do we prepare the account? Well, the transactions that are going to be recorded in the account are credit purchases, purchase returns, any discounts received, and any payments made to credit suppliers. Now remember what we said earlier. This is a liability, and therefore we would always expect there to be an overall credit balance on the account. With that in mind then, we know this account is a liability. So any of the above transactions that are going to increase the account value, i.e. increase the amount of money owed to suppliers, will be a credit. And any transaction which reduces the amount of money owed is going to reduce the value on the account and therefore be a debit. Let's have a look at an example to put this into practice. You've been given the following transactions and have been asked to prepare the Payables Ledger Control Account and enter the balance carried down at the end of the month. The balance brought down being 32,400, credit purchases 18,230, purchase returns 988, discounts received 102, and payments to suppliers 24,204. Let's first draw up our T account and then work through each of the transactions. We'll start with the balance brought down from the previous month, and this will always be entered on the credit side of the account. This shows the amount owed to suppliers at the beginning of the month. The credit purchases would then be entered on the credit side of the account, as this would further increase the amount owed out from the business. Purchase returns would reduce the amount owed by the business and therefore be a debit to the account. Discounts received would also reduce the amount owed by the business, as they've received a discount on the credit purchase for paying quicker. This is also referred to as a prompt payment discount. This would therefore be entered on the debit side of the account. Lastly, payments to suppliers. Well, this would definitely reduce the amount of money owed to suppliers and therefore be entered in on the debit side of the account. The final step would be to balance off the account at the end of the month and enter this in as the balance carried down. To do this, we add up our debit entries, which come to 25,294, then add up our credit entries, which come to 50,630. Find the difference between the two sides, which is 25,336. Now we can enter this in as the balance carried down on the lower side, which in this case is the debit side of the account. Remember, this would be your opening balance, i.e. balance brought down, at the start of the next month. And that wraps up my guide on the Payables Ledger Control account. I hope you found it useful, and if you have, remember to hit that like button and subscribe to the channel for more AAT content. Thanks again for watching. I'll catch you in the next one.